Let's start with a hard truth that most self-employed business owners don't want to hear. Working harder is not the solution to building wealth. In fact, it might actually be keeping you poor. Here's a hypothetical scenario I see all the time. Let's meet Sarah. She's a freelance marketing consultant who left her corporate job 3 years ago. She's now making $150,000 a year, more than she's ever made as an employee, but Sarah works 60-hour weeks. She's constantly chasing new clients, and if she stops working, that money stops flowing. She's exhausted, she's stressed, and despite her six-figure income, she has barely $20,000 in savings. Sarah's stuck in what Robert Kiyosaki calls the self-employment trap, and that data backs this up. While the average self-employed person at age 55 earns $134,000 compared to $79,000 for traditional employees, that income comes with a catch. It's tied directly to your time and your effort. Stop working, that income disappears. The fundamental problem is this. As a self-employed business owner, you're still trading time for money. You might have left your corporate job, you might be your own boss, but you haven't actually escaped the employee mindset. You're just working for yourself instead of working for someone else. And that's a critical distinction that keeps most business owners from building real, lasting wealth. To understand how to break free from this trap, we need to talk about Robert Kiyosaki's cash flow quadrant. This is a framework that divides how people earn money into 4 categories. You've got the employee, the self-employed, the business owner, and then the investor. I actually read these books in my 20s and really helped shape how I help clients manage money and how I manage my own businesses and my own net worth. So let's break each quadrant down. So we've got the employee quadrant. You work for someone else, you're trading your time for a paycheck. It's pretty straightforward. In the self-employed quadrant, you work for yourself, you're a freelancer, you're a consultant, you're a small business owner who does most of the work. And in the business owner quadrant, you own a system where other people work for you, allowing you to earn income without being directly involved in every aspect of the business. And then the investor quadrant, your money works for you through assets that generate passive income. Here's the key insight. Most self-employed business owners think they're in the business owner quadrant, but they're actually stuck in the self-employed quadrant. And what's the difference? If you can't take a month-long vacation without your income dropping to zero, you're self-employed, not a business owner. Why do business owners get stuck here? According to a FinCart, it comes down to 3 main reasons. First, they lack proper systems. If the business depends on your personal involvement, you can't scale it. Second, there's a mindset issue. You're thinking like a worker, not a leader who builds a team. And third, there's a scalability problem. If your business can't grow without you working more hours, you're in the self-employed trap. The path to real wealth means transitioning from the left side of the quadrant, employee and self-employed, to the right side, which is the business owner and the investor. That's where financial freedom exists. Before we can talk about building wealth, we need to understand what wealth actually means. And Robert Kiyosaki has a simple, powerful definition that differs from what most people think. An asset, according to Robert, is anything that puts money in your pocket, and a liability is anything that takes money out of your pocket. It's not about what accountants say or what looks impressive on paper. It's purely about cash flow. Does it make you money or does it cost you money? Let me give you some specific examples for business owners. Let's say you own a rental property that generates $2,000 a month in rent, and your mortgage and your expenses are $1,500. That's an asset because it's putting $500 a month in your pocket every single month. But let's say you lease a fancy office space for your business, and that's $3,000 a month in cost and doesn't directly generate any revenue. Well, that's a liability. It takes money out of your pocket. And here's another example that surprises people. Your personal vehicle. If you bought a $60,000 SUV on a 5-year loan for your business and it cost you $1,200 a month in payments, insurance, and maintenance, but it doesn't directly enable you to earn more revenue, that's a liability. However, if that same vehicle allows you to serve clients in ways that generate $3,000 in additional monthly revenue, that's an asset. Even your home, which most people consider their biggest asset, is actually a liability according to Robert Kiyosaki. If you're living in it, it requires monthly payments for your mortgage, for your property taxes, for your insurance and your maintenance, and it doesn't generate income. Only if you rent it out at a profit does it become an asset. The key principle here for business owners is pretty simple. If something routinely brings in more income than costs, it's an asset. If it requires ongoing payments, with no offsetting income, it's a liability. Real wealth building means acquiring more assets and fewer liabilities. Now that we understand the difference between assets and liabilities, let's talk about the practical strategy. How do you systematically redirect your business cash flow into income-producing assets? First, you need to establish a baseline. And according to BCBP accountants, self-employed individuals should build an emergency fund that's larger than traditional employees. Aim for 6 to 12 months of living expenses instead of the standard 3 to 6 months. This is critical because your income is more volatile. Let's say your monthly expenses are $5,000. Your target emergency fund should be $30,000 to $60,000. Once you have that foundation, here's a system I recommend. Every month, before you pay yourself a salary, allocate a percentage of your business profits to your wealth building fund. Start with 10%, if that's all you can manage, but work your way up to 20 to 30% as your business stabilizes. Let's walk you through a hypothetical example. Imagine you're a self-employed consultant who's generating $15,000 a month in revenue. After your business expenses of $3,000, you have $12,000 in net profit. Instead of paying yourself that full $12,000, you pay yourself $9,000 for living expenses, and you allocate $3,000, that's 25%, to your wealth building fund. That $3,000 per month, $36,000 per year, now gets automatically invested in income producing assets. You don't see it, you don't spend it, and over time, it starts working for you. This is the key to breaking free from trading time for dollars. The crucial part is the automation. According to Side Pocket, you should set up automatic transfers to investing accounts during high income periods to ensure consistent wealth building, even when your income fluctuates. And if you have a great month and you bring in $20,000 in profits, maybe allocate an extra $2,000 to the investments. The system adapts to your irregular income while maintaining the discipline. Now let's talk about where to put the money. Not all investments are created equally, especially for self-employed business owners with irregular income. Here's the hierarchy I recommend. First tier, tax advantage retirement accounts. As a self-employed individual, you have access to powerful retirement vehicles that traditional employees simply don't. The solo 401k allows you to contribute up to $70,000 a year in 2025. And if you're over 50, you can do an extra $7,500. The SEP IRA lets you contribute 25% of your net earnings, also capped at $70,000 for the year. These contributions are tax deductible, meaning they reduce your taxable income now while you're building wealth for the future. Let's use our earlier example. If you're allocating $36,000 per year to wealth building, you could put that entire amount into solo 401k, reducing your taxable income from $144,000 to $108,000. That's a massive tax savings. Second tier are dividend-paying stocks and index funds. According to Wall Street Zen, dividend stocks from established companies typically yield 2 to 6% annually, providing regular cash flow while also offering potential for long-term growth. Index funds and ETFs that track the overall market, like the S&P 500, offer the diversification with lower fees. Historically, these index funds have returned about 8% annually over the long term. The third tier is real estate investment trusts, or REITs. These allow you to invest in real estate without the complexity of being the landlord. REITs typically yield 4 to 10% in dividends and have historically earned about 11.8% annually, compared to 10.6% for the S&P 500 index. The beauty of REITs is you can start small. Platforms like Fundrise and Realty Mogul, they let you invest with as little as $500. And the fourth tier, direct real estate investments. Once you've built up capital, owning rental properties can provide significant cash flow and tax advantages. But this requires more management and more capital, so it's typically not where you start. The key is diversification. Don't put all your eggs in one basket. A solid allocation might be 60% in stocks and index funds, 30% in REITs and real estate, and 10% in bonds or some other alternatives. This balances growth potential with income generation and stability. Perfect for business owners who need some type of predictability alongside their irregular business income. And here's something most self-employed business owners don't realize you have: tax advantages that W-2 employees can only dream about having. Let me show you how to leverage them for wealth building. First, let's talk about self-employment tax deduction. Yes, you pay more in Social Security Medicare taxes, 15.3 of your net earnings compared to 7.65 for employees. On $100,000 income, That's an extra $7,650. But here's the advantage. You can deduct half of that self-employment tax, $3,825, on your income tax return, reducing your taxable income. Second, health insurance premiums. If you're self-employed and not eligible for an employer plan, you can deduct 100% of health insurance premiums for yourself, your spouse, and your dependents. For a family plan costing $18,000 a year, that's a significant deduction to W-2 employees don't get. Third, the home office deduction. If you use a portion of your home regularly and exclusively for business, you can deduct either $5 per square foot up to 300 square feet, or the actual expenses based on the percentage of your home used for business. Let's say you have a 200 square foot home. That's a $1,000 deduction using the simplified method. Fourth up, vehicle expenses. If you use your car for business, you can deduct either the standard mileage rate, which is 70 cents per mile in 2025, or your actual expenses like gas, maintenance, and depreciation. If you drive 10,000 business miles per year, that's $7,000 deduction. And here's a new one for 2025, the qualified tips deduction. Under the One Big Beautiful Act, self-employed individuals in tipped occupations can deduct up to $25,000 per year in qualified tips received and reported. Phased out for higher incomes, but this is a game changer for certain service and industries. When you add these up, retirement contributions, health insurance, home office, vehicle expenses, and other business deductions, you can easily reduce your taxable income by $50,000 to $70,000 or more. That's savings of $12,000 to $20,000 that you can redirect into wealth building investments. W-2 employees simply don't have access to this level of tax optimization. So how do you actually make the transition from self-employed quadrant to the business owner and investor quadrant? Here are the practical steps that I would use. Step number one, systematize your business. Document every process, every client interaction, every task you do. The goal is to create a business that can run without you. Start by identifying the tasks that only you can do versus tasks that someone else could handle with proper training. Two, build a team or outsource. You don't have to hire full-time employees right away. Start with contractors or virtual assistants for repetitive tasks. Let's say you spend 10 hours a week on administrative work. If you can hire someone for $25 an hour to do that work, that's $250 a week, that's $13,000 a year, to free up 520 hours of your time. What could you do with an extra 520 hours? I could think of a few things I would do, but you could focus on higher value activities or simply just reclaim your life. Number three, elect the S Corp status strategically. If your business is generating over $60,000 in profit, it might make sense to you elect S Corporation taxation. This allows you to pay yourself a reasonable salary, let's say $60,000, subject to payroll tax, but take the remaining profit as distributions that aren't subject to self-employment tax. On $120,000 profit, that potentially saves you $9,180 in self-employment tax. Of course, you're going to want to consult with a tax professional to see if this makes the most sense for your situation. Four, automate your wealth building. Set up automatic transfers from your business account to your investment accounts. Make it a bill you pay yourself first, not something you do with the leftover money. Use dollar cost averaging, a consistent amount regularly, to smooth out the market volatility and remove any emotional decision making when it comes to investing. Number five, you want to track everything. Use accounting software to categorize expenses and to maximize deductions according to fresh books. Proper tracking can uncover thousands in overlooked deductions. The IRS requires documentation, so keep receipts, mileage logs, and records of all business expenses. Number six, build multiple income streams. Don't rely solely on your primary business income. Develop passive income sources, rental properties, dividend stocks, online courses, affiliate marketing. The goal is diversification. So if one of your income dries up, you're not devastated. The key is to be patient and consistent. This transition doesn't happen overnight, but every month you implement these strategies, you're moving closer to the other side of the cash flow quadrant, where your business and your investments work for you, not the other way around. So let me address the objection I hear most often. This sounds great, but I need all my cash flow just to cover my expenses right now. I can't afford to do the things you're telling me to do. I get it. I've been there myself. I've been in a situation personally where I was generating $1.2 million in revenue, top line revenue. Thought I had everything under control. And when I looked underneath the hood, I was losing $20,000 a month. By following the same steps that I'm outlining here, within 7 months, I was able to turn my business around and turn it from losing $20,000 a month to making 60% net margins. So just to give you an idea, on $1 million of revenue, losing $240,000 a year, from that to making $600,000 a year, all by using the system that I'm laying out for you right now. So number one, you're not alone. Number two, you can do it. But number three, it's going to require you to start looking at where you're spending money, because I guarantee you, you've got things going on inside of your books that you can't see because you're not paying attention. I know for me, this thing right here, I was spending a lot of money at Dunkin' Donuts and Starbucks. I was hitting it 2-3 times a day on average. Now I drink 1 cup. Why? Because I don't want to give them that much money. I mean, I like the coffee, but it's not that good. I'd rather be doing other things with the money. So once I saw, that keeps me from spending more money on this. And now when this is finished, I'll switch over to my water. So you're not alone and you can do it, but you have to start. You know, and according to Pew Research, 1/3 of workers say they rarely or never have money left over at the end of the month. See, so that's a third of the people out there surveyed say, hey, at the end of the month, I don't have any money left over. I rarely have enough. So you're not alone, but this is why you need to get started. If that's you, here's what I would want you to consider. First, this is often a lifestyle issue, not an income issue. If you're making $150,000 a year and have nothing left over, the problem isn't your income, it's your spending. The data shows that self-employed individuals who earn income often spend just as much or more to maintain the lifestyle that matches their peers. This is a trap that Sarah fell into. Remember I mentioned Sarah in the beginning of the video? Second, you're already paying someone, just not yourself. Between taxes, business expenses, debt payments, and lifestyle spending, every dollar is going somewhere. The question is, are you prioritizing your future wealth, or are you prioritizing everything else? And here's a practical exercise. For the next 30 days, track every single dollar you spend, both in the business and both in the personal. I guarantee you'll find money leaking out in places you didn't even realize. Maybe it's a subscription you're not using, maybe it's eating out too often, or business expenses that aren't actually necessary. Most people, they find $500 to $1,000 per month in unnecessary spending just by paying attention, like my example of this. Third, when you start putting money into investments, you can start small. Just start. You don't need to put $3,000 a month right out the gate. You can start with $200. You can start with $100. $200 a month, that's $7 a day. And over 30 years, investing just at $200 a month at an 8% return, well, that grows to over $280,000. And that's the power of compound interest. But if you wait 5 years to start that same $200 a month, it only grows to $177,000. Delaying costs you over $100,000 in wealth. Fourth, reframe this as paying yourself first, not depriving yourself. You're not giving up your lifestyle. You're ensuring your future self has the lifestyle freedom that it actually wants. The self-employed workers who successfully build wealth don't earn dramatically more than their peers. They just prioritize differently. And finally, remember this. If you don't build assets now, you're committing to working forever. And according to the Transamerica Institute, 55% of self-employed workers expect to retire at age 70 or later, or not at all. Is that the future you want? Or would you rather build a portfolio of income-producing assets that gives you the options to work because you want to, not because you have to? The choice is yours, yes, but it starts with the decision to pay yourself first, even if it's uncomfortable at first. Building wealth as a self-employed business owner isn't about working more hours. It's about working smarter, understanding cash flow quadrants, and systematically converting your earned income into assets that generate passive income. It's about leveraging tax advantages you have as a business owner, building systems that free up your time, and consistently investing in your future. If you're ready to take the next step and want personalized guidance on how to implement these strategies in your specific situation, I encourage you to visit my website or schedule a consultant using the link below. Take a look at your business structure, your tax situation, and we'll create a customized wealth building plan that works for your unique situation. And remember, the self-employed business owners who build real wealth aren't the ones who work the most hours. They're the ones who understand how money works, how to make it work for them, and let's start making that your story. Thanks for watching. I'll see you next week.